Good morning, traders. Today is February 11th, Saturday. This is Brad Matheny. This is the custom index video. I've just completed the last two videos, the TT scanner video and the MENT rotational modeling and real estate video. And I want you to be very cautiously aware of what is taking place right now. We are entering into a broad flagging formation. I'm going to try to show you here that we are in a broad flagging formation, which will eventually flag out like this. And I am going to try to show you why you need to stay very cautious right now. This is a word of warning for everyone. We are not out of the woods yet, and we need to stay very, let's try this again. Make it thicker. We need to stay very aware that the markets are going to consolidate and are going to stay very risky overall. So here's our broad flagging formation setting up. We could very likely move back into these lower areas, 395. Possibly 390 on the SPY. I believe that we are going to see an upward trend, just like I've drawn here with these cycle phases, continue to play out. But throughout this entire time frame, which again moves us all the way out to January 2024, we could very well stay in an extremely cautious mode throughout the rest of this year, which is what I was trying to warn you over the past 3 or 4 weeks. We are in no way, shape, or form overly aggressive to the upside, okay? Nor are we overly aggressive to the downside. We should be very neutral to market trends right now. We should be very cautious, and I want to highlight this one chart which really tells us everything. This is the U.S. Custom Valuations Trend Index. In all uptrends, we have seen a broader upward cycle move in the valuation trend index. You can see here after the 2008-9 collapse, we started to get a basing move. And then in 2011, we started to see some real upward trending. We saw a pause in 2011 and going into 2012, which is where the Fed ended quantitative easing. Then they restarted it, and we saw a broad valuation uptrend. Then they ended it again. Then they started it again. We saw a broad valuation uptrend throughout a little bit of rotation here during the election cycle, which is again where the Fed ended some QE. Then we moved into this upward peak. Then we saw this broader cycle decline, which is really devaluation of U.S. assets, okay? Then we saw this bottom, 2018, early 2019, which prompted a very strong valuation uptrend, a huge uptrend. We've come back down and based down in here near this 272 level. I believe, ladies and gentlemen, we are not going to see any real substantial price appreciation in the U.S. and global markets until we see an upward trending here. The U.S. markets really drive global markets because we are the broadest and biggest economy on the planet. And more than likely, we will see some upward trending eventually, but it may not happen until June, July, August. Once this valuation trend index starts to move upward with some real substantial trending, meaning we get 2 or 3 upward bars and start to see higher highs, higher lows, we need to stay very cautious. This is not the same market trend. This is very much the risk that we take right now. And again, coming back to this chart, I need you to be aware that this cycle pattern, this phase of market trending is our big concern right now. I believe that we are likely in a moderate uptrend right now, which is why we are taking advantage of some of these trends. But I believe that all of us need to be aware that the rest of 2023 could be very consolidated. Hypothetically, ladies and gentlemen, if we do not see this upward trend, like I've drawn here, we will see something that looks like this: A, B, C, D, and then an upward trend. And that is very likely to be an alternate universe for us. We either have a continued upward trending cycle as I've drawn here in this. I'll change the color here to green. So there's our primary analysis of an ABC upward wave, or we have the alternate analysis here, which would be a flagging formation, suggesting that we see an A, B, C, D, E breakout. So that's where we're at right now. We're moving up towards this peak. This gives us a 7 to 8% upside target, maybe 9.5%, possibly targeting 435, 440. I would call this range anywhere from roughly 424 to 440 on the SPY. Then we will likely roll over. If we do not find support around, let's call it 415, 418, then we're likely to try to move back down to this channeling cycle here, which may end up being our downward cycle around 395. Then we will base and bottom and flag out and eventually range to the upside. This would essentially be an alternate A, B, C, D, E formation, or possibly just a broader A, B, C, and then a pullback. Remember, I had indicated here that we would likely see some sort of a rotation in early 2024. Which could be a move like this, where in early 2024, we could see a move up out of this area, some sort of a pullback, flagging formation, and then a move back up. This could happen. And now, like I said, we need to play it week by week as we move forward. There is no reason for us to get overly aggressive right now. The reality is what we need to do, ladies and gentlemen, is we need to prepare for this next little 7 to 10% move, and then realize we are going to go through about a 2.5 to possibly 4.5 month pullback, which will look like the markets are collapsing, but I really believe that we are just flagging out. This is going to be a great downside move. It could be very risky for people that are unprepared, but you are being prepared by my research right now. And this is likely going to start in May or June of this year and could continue down into this cycle phase back over here, which would be August, September, October, before we start a new rally phase. This would be considered like a moderate Christmas rally, maybe very quickly coming up, hitting this level, basing, and then breaking out of it. We'll see how it plays out. Okay, now let's go to the custom indexes. This is the new core commodity index, flagging out and weakening. This is actually good for the economy. The Fed needs to see commodities continue to weaken and commodity demand continue to weaken. I believe as long as we stay down in these yellow and green areas, we will see continued deflationary cycles, which is good. The Fed may eventually move into a moderate weakening stance. I don't believe that the Fed wants to break the bubble, but understand they want to see some real solid downward trending of inflation. And we're still seeing moderate upward inflation cycles right now. The accumulation cycle phase index is moving downward, just as I predicted. This is good for the markets to move upward. This is the SPY up here. We need to see this continue to stay in a downward trending cycle. This is a monthly cycle phase. So if we get a reversal up here to the upside, breaking this blue line, we could be in some serious trouble on downside move. Well, right now, this is the RSI and the stochastics are moving downward. This is very good. We're in a moderate upward trending phase right now. Again, we could still see weakness. Remember, we are very cautious right now. The cash flow index collapsed downward, like I mentioned. This is a weekly chart. Up above this channel right here, we're getting into some real weakening. Now, obviously, we have a moderate channel cycle up here. So these are peak levels you could see here. We come back down into these deeper levels. This is COVID. This was the COVID low. We're now down in these cycles. I think we're going to just migrate back up into this 1.6, 1.65 area, but we could see the markets roll down into this 1.35, 1.4 area and consolidate. So be aware that we could see some consolidation. I'm not expecting any big reflation cycle up into this mode. This is going to come, in my opinion, second half of 2023. So at this point, we're going to kind of stay possibly in this type of a cycle, moving in and around this blue level back over here, moving in and around this 1.4, 1.35 to 1.65 area, moving in and around this area, just in a moderate uptrend until we potentially reach that peaking formation that I mentioned to you. And I'll show you again. Custom Consumer Index, the Consumer Engagement Index is falling again. Surprise, surprise, right? So we had this big rally last month. This was a great rally in January. We're consolidating again. We could see another couple months of a pullback. I believe that we're going to continue to flag out. This is another reason why we need to stay cautious. Again, with your allocation levels, if you're following the MENT rotational modeling system, we're 100% bullish right now in the SPY. Generally, though, in your trading account, I'm having you keep a 25 to 35, possibly 40% cash reserve, meaning you need to be very cautious in your trading. This is not the base and bottom yet. We do not know. We do not have confirmation. We need to be very aware of the weakness that's still in place in the market and let it play out. It looks like an early bottom is setting up. We will have to see, but there is still probably a 50-50 chance that we could have some sort of a crisis event over the next 12 or 16 months. And I'll show you as we move forward. We basically need to stay extremely cautious, as I mentioned to you from the start. The devaluation cycle trend index, this was a month ago. I'm going to skip this right now. The large cap index is finding a little bit of support right now. We'll see how this plays out. This is a monthly chart. We are nearing the end of a cycle. So as we end this cycle here next month in March, we could start a moderate large cap growth phase. This could be very good for large caps. But again, we need to see how this plays out throughout the end of this month, February. If we end up back down into these low areas, call it 120 or let's call it 150, I guess, 55, then we are going to be looking at some general weakness in the market. And I think that's kind of where we're at. I think we're going to take a couple more months of general sideways trending before we start to see some real upward growth. Okay, the global asset index is doing the same thing. It's kind of basing and bottoming, but I still believe we could see a couple more months. Figure all the way out through June, July, we could see sideways, range-based bottoming, maybe even an extension potentially near a new low, but we are not yet seeing real price appreciation. We're in early stage basing and bottoming. That's where we're at right now, folks. Early stage basing and bottoming. Do not become overly aggressive to the upside and do not become overly aggressive to the downside. Theoretically, this is the time where you should be waiting with a large cash reserve, properly hedged, waiting for these biases to resolve. Okay, gold cycle trend index or cycle phase index. Again, we're seeing accumulation. I believe we're getting closer to an upward move in gold. I believe it's really going to kick in 2024. Now, I've drawn these arrows many months ago, and I may have to extend them out another 8, 10, 12 months to the right side. But again, you can almost see we're in this basing bottoming formation. We've come down, hit this low, rallied back up, which shows some accumulation. Then we've distributed out into this sideways basing bottoming formation. This is very good for gold. Don't take it the wrong way. This is excellent for gold. We're basing and bottoming near 1920, 1960 in gold. And once we get into the appreciation phase, gold should really begin to skyrocket. But that move may come in 2024, 25, 26, and maybe more of a kind of a sideways flagging, and then maybe an initial move, kind of like we saw here in 2024, stalling back out maybe into 2025, and then moving 25, 26, 27. Okay, so very good for for gold. Understand that this is exactly what we want to see if you are hedging your investments in gold. This is accumulation in a basing formation near 1960, let's call it. And that means that the next big move in gold could put us up above $5,000, $6,000 once it really takes off. The innovation index has rallied back up. This could be the end of the move, folks, in innovation. Depending on what happens over the next couple of weeks, we could see a little bit of a move up into this 80, 85 area, but then I really think we're going to flag back out down here to the downside. I think we need to get it out of our system. To put it bluntly, this is not going to be a V-shaped bottom. This is going to be more of an extended basing bottoming formation. And I think we're looking at another 4 to 6 months of extended basing before we move into a moderate rally at near the end of the year. So be prepared. If you're trading these things and you want to try to, ride this all the way up, I don't think you're going to see it. I think you're going to see a lot of rotation, a lot of sideways activity. As I mentioned to you in last week's video, I think 2023 is going to be a very dangerous year for traders if you don't know what you're doing. And I believe we could see this stall back out, roll back down to retest these lower levels, which would essentially be another 20-25% downside move in technology over the next 2 or 3 months before we begin another rally phase. So be aware that everything is still very fragile. I don't know how I can make that point any clearer. Be aware that we are going to see some real rotation here. Okay, the fear index is at 5.48. This is great. We want to see this continue to move downward. This will spike a bit if we get a downtrend. So be prepared. Over the next couple of weeks, we could see it possibly up into the 6.5, 7.5 area. But we need to, a real big downtrend would be up over here. Okay, and we could see it spike, meaning we could see some real fear in the markets if we get a pullback. But right now, we're basing, we're bottoming, we're looking good. We need to see this trend continue and stay within these cycles. The market sentiment index is stalling in this middle channel area. I believe we could see something like this. And you can see here, during the big COVID spike, you see how we stayed in these elevated areas through this uptrend. This was, again, Fed quantitative easing and zero interest rate policy. I believe we're going to kind of do something like this moving forward. We still could have those big 15, 16, 17% pullbacks, but I believe we're going to move into some sideways channel, maybe with one broad pullback in April, May, June, July, some kind of a broad pullback, possibly down into these lower channels, and then spike. The fear index could potentially spike a bit, and then we're going to move into an upward trending through the end of 2023. That's where my research is leading me. Next, we have the real estate cycle index. Oh boy, it shot back up last week into extreme hostility. This is, again, getting very ugly for the real estate market. And I believe we could see an aggressive move back to the downside. This would indicate that we are going to see a downside activity and pricing pressure. Pay attention to my weekly real estate updates. We are back into extreme hostility. Really, really quite ugly when you think about how extreme the market trends are right now, with rates rising, with inventory rising, with days on markets rising, and price reductions rising. Everything is set up right now for kind of the bottom to fall out of the market to some degree. Again, when I say that, I think we could be looking at a 2 to 3 year downward cycle trend in real estate. It may not be a collapse. It may just be a deflationary downward 24 to 36 month cycle trend, kind of like we saw right here, or kind of like we saw right here. A broader downward cycle trend. This was the real estate collapse, but I want you to understand from a standpoint, the Fed will react and maybe not bail out, but the Fed will react and change the sentiment of the market. It just may take 4, 5, 6 years and may prompt a 25 to 45% real estate market decline in real price value. Okay, next, custom technology index stalling out. Again, this is a monthly chart. Very good indication we could see a sideways rotation in the market. As I'm telling you, be prepared that we could see, 4, 5, 6 months worth of sideways trending here, not really seeing a rally, a real honest to God rally phase in the US stock market until October, November, December, maybe into early 2024. And I'll go back to the chart I showed you earlier before we end this video, trying to move this along as quickly as I can. Okay, the US to global market index, again, I think we're going to stall out near these 50% retracements. So draw an imaginary line between this high up here and this low. 50% is right in this area. I think we're going to stall out right over here. So we could see another little upward blip up into this area, trying to maybe get just above these highs and then stall back out. Same thing applies here for the global market index. We've seen a nice break of this trend, but in reality, we're going to get up into this 50% area, which is right in this 31, 32% area. So another upward move above this high, and then we're going to stall out. So this is what we're looking at over the next 5, 6 weeks. Another upward move, maybe 5, 6, 7, 10% in the global markets and the US markets back up into this 50% area. Then we will stall back out. So that means we have an upward trending bias for the next 5 to 8 weeks, hypothetically, until the end of April. And I want you to be aware that we have some real risk in the markets. We have 6, 7, 8 weeks maybe of upward trending. Then we have to shift gears. We have to be prepared for a broader cycle pullback, which could be a month or two of downward cycle trending before we potentially move into an upward cycle near the end of the year. Again, somewhere between September, October, November. And again, this is the chart that tells us the primary lack of real valuation appreciation. So again, as long as this stays into a sideways trending market, we are not going to see any broad upward trending. So pay attention to my US valuation trend index. Oh boy, I cannot tell you how important this chart is. Really, this is telling us that we could roll over here. We could roll deeper to the downside. We could roll over here and try to resolve to the upside. But until we see some real price appreciation, the risks stay elevated. So that tells us right now that, 60-40, 50-50, you should not be overly aggressive in the markets. This is still very risky with regards to upward bias continuation. The U.S. leading market index has rolled over, as I mentioned to you. This is a weekly chart. We could come all the way back down into these areas on a pullback. I think that's going to happen in May and June, ending possibly in July. So we could stay elevated in these areas up above this, call it 2.0 to 2.3, 2.4 area. We could stay up in these areas on a mild reflation trade, and then come end of April, we need to be aware of the fact that we're likely to roll over. And then May, June, July, we need to be prepared for downward cycle trending, which could put us back down into these lower levels, retesting lows. And I'll again point out that that would put us back into this area here, possibly down into this area if we get an extended pullback. This would still be technically an uptrend setting up, ladies and gentlemen. Just understand that I believe this end of April peak is going to be important to be aware of. That's around April 24th or so. Then we have a base which could occur in end of July or middle of September. And then that's where we start the next phase to the upside. Okay? That's what I'm trying to warn you of right now. Next, we have the volume ratio. Volume last week was very minor. You can see here we did not see a whole lot of accumulation. Obviously, with the sideways rotation and the downward trending that we saw potentially a bit last week, you're not going to see a lot of accumulation to the upside. I wouldn't be too concerned of it right now. I don't believe this is a crisis mode setting up. I believe this is just a pause in upward trending. But again, we want to be aware that we do not want to see a big, broad shift. We want to see some more accumulation mount and continue to build into the April time frame. I believe that's going to happen probably near the end of February. We'll start to see some upward trending. Commodity to gold index fell considerably. This is beautiful. This is exactly what the Fed wants to see. Deflationary cycle trends with regard to commodities. We want to see this continue to move downward, ideally back down into these lower channels right here. That would be perfect. If we get down into these downward cycle trends, these extreme lows, that would be quite deflationary. That may prompt the Fed to move a little bit weaker, indicating inflation trends appear to be over. We do not want to see this reflation trade weaken to extreme levels. That would put us back into a potential crisis mode. But we do want to see it move downward. We do want to see the higher interest rates actually deflate commodity prices and holding with gold holding up quite well. So we want to see gold stay above 1910, 1920, and we want to see the rest of the commodities continue to deflate. I believe that the decreasing housing market will do that organically for us. But again, this is a good move. We did not want to see this reflate back up here. This means the Fed would have to become even more aggressive and possibly something would break. We need to see this stay in a downward cycle throughout pretty much the rest of 2023, maybe in 2024, trying to get above this 2.2 level and showing some sort of a change in inflationary trends. Okay, the metals trend index. Okay, gold, even though I forgot to invert this. So black bars are really white bars are really black. I'll change this before I put it up on the website. We have seen this pullback in gold. This is very solid. We're holding up right now up in this area, this 382 area, which is 11,676. Remember, this is not real gold prices. This is my custom trend index. Very solid that we see this reflate back up into this 12,000, 12,400 area. I think that's the next big phase for gold. We'll see how it plays out. But this is a very solid rally phase, folks. And like I said, gold holding up above 1920, 1940, and really beginning to base here would be a very good accumulation phase for the next big move, which is gold up to 2,200, 2,400. That's going to put us up into this area. And then we'll have another phase up to about 1,450 on this chart, which is where we're going to run into our first stalling area. FANG's index resolving back here to the upside. We're near this middle channel area. This is good. This is traditional trending because of the fear that I think is going to set up near April, end of April. I think we could see this roll up a little bit further and then roll back down. I think we're going to stay in this channel, in this green channel, and down into this lower blue channel, probably until July, August, September. Then we'll get some big upward trending. So be prepared. FANGs could stay moderately consolidated over the next 4 or 5 months with some big volatility. So be aware. Okay, the metals index. This is the actual metals index, the one that I started with, where I have been reporting what I call the yellow brick road, which is this area. We stalled at the lower channel. I really want to see this move up into the yellow brick road, which is this area. You can see this upward channel here and here. This stalling area is very, very solid. This is above these channels. You can see this support back over here, this resistance here, resistance here, resistance here. This is actually a very solid area for us to base and bottom and move to the upside. I think the next big rally phase in gold, once this resolves, is going to be back up into this upward channel, this above this gold line here, probably before we reach this area, this apex area right here. I think we're going to see it rally back up, stall, and then prepare for the next big move up. So be aware, this is a broad early cycle appreciation phase in gold. Next, smart cash index. This is actually the global market index rolling over. We're going to try to find support back over here around 155, 150 area. And this is going to give us a real indication of what the global markets are doing. If it breaks through this support area around 150, we could see another retest of a low back down in here. Remember, these were COVID lows. There's nothing stopping the market from going into another congestion phase between now and, say, September. The only thing stopping the market from going into a congestion phase is the belief that we have deflated enough back over here, and now we're in some mild reflation trade. But remember, reflation is going to be based on the fact that we've reached an extreme level here. So this is think of it as a reactionary move that could move us up into this 170, 175 area. But ideally, we need to see organic growth in the economy, and we need to see real valuation appreciation. So we're in a kind of a reactionary mode right now before we're starting to see real value appreciation. So be aware that we could see a lot of volatility between now and, say, October, November of 2023. Okay, we've gone over this in the MENT rotational modeling video. We are now bullish on the weekly, bullish on the daily. That means we're 100% bullish in the MENT rotational modeling system. The MENT rotational modeling system has done very well over the last couple of weeks. Let me show you. This is our allocation level for trading. So think of these as two separate accounts. We have your trading account, and then we have your investment account. Your investment account should be 100% into bullish trending activity, meaning your retirement account should be back into 100% invested in SPY related stocks. So moderately high beta or safely protected beta stocks. We're back 100% into trending. If we get some weakness, the daily and the weekly will roll into bearish trending. I'll alert you when that happens. But right now we're in an early stage basing and bottoming phase, which is why the MENT rotational modeling system went into bullish trending. When we get into the trading account, which is only 10 or 20% of your actual trading capital, total trading capital. So hypothetically, you have $1 million in assets. You would have $900,000 in your investment account. You would have $100,000 in your trading account, hypothetically. And in your trading account, you would have your allocation levels set up as 50% tradable, 25% in cash, and 25% allocated to metals based on my custom index modeling. Alternately, if you cannot invest in metals, you would have 65% in stocks, 35% in cash, 0% in bonds. These are the trending systems related to the MENT rotational modeling system for the primary indexes that we follow. I added a few of these consumer staples, crude oil, and the mid-cap a couple months back. You can see we've moved back into moderately bullish trending. We need to see this continue. Ideally, we need to see the NASDAQ move into bullish trending. Hasn't happened yet. So understand that this is a real mixed market here. Bonds are not performing either. But again, you would want to stay relatively protected even though the investment retirement account is long, 100% long right now. This is an always-in system. So it's either going to be, bullish or bearish based on weekly and daily analysis. Combining the weekly and daily puts us into the combined position, one account, which is 100% bullish. And we have our new trigger as of 2/3. We are 100% bullish, and we are off 0.86% right now. Historically, the MENT rotational modeling system has done extremely well. So take a look at this. This is really where we're at as of right now. We're just below new all-time highs. If we do get the rally that I'm expecting, we will push to new all-time highs probably by August, September, October. The quarterly performance has been outstanding. We've only seen a couple of pullback months, but they've always been followed by some real solid gains. So a couple of months here, -7%, -11%, followed by an 11% gain. We've only had a couple of losing years. One, 2011, which was right over here, the end of the year, middle of the year, end of the year, right here. We had some drawdowns. Last year, we ended up minus 1.06% in 2022, and we're already up 0.05% so far this year. Looking pretty good. Okay, let's go on. The stock market index weekly chart, you can see we've broken away from this apex. This is what I've been telling you for months. We're now in this upper channel. we're probably going to run up into this area, folks, okay, which is going to be retesting this high. Probably going to run up into this area, maybe a little bit higher, and then we're going to likely stall out into April. So be prepared. This is the 6.5 to 9.5% rally that I keep warning you about, getting just above this level, which will be putting us back right above this middle channel here, and then we'll stall back out, probably attempt to come back down, maybe to this level, this support level here, which is this bright blue line. But I think we're going to see this move up into this 1200 area and then really roll back down, try to find some new support, maybe weaken for 60, 65, 75 days before we find some support. The valuations chart index weakened again. This is great. We want to see this continue to base and bottom. Ideally, we want to stay above these lows over here, and we want to stay below this kind of a red channel area here. This is ideally what we want as the markets form a bottom. So to say hammering out a bottom, we want the valuations to stay relatively low before we get some real organic appreciation. So this is very healthy. This is called hammering out a bottom. And again, 2023 could be relatively dangerous if you're unprepared for these trends. And the volatility index here moved downward just as I expected. Remember, folks, this is one of my favorites. In fact, I'm starting to really love this and the U.S. valuation trend index. All of these indexes really help me gauge what's going to happen going forward and give you an idea of what the trends are really going to do. So, okay, so here's the bottom line. We've broken up here to the upside. We've broken into a new upward cycle. We need to see some confirmation here. We got above this high. We got above this high. We're not getting above this high yet. Okay, we probably will before the end of April peak that I am projecting or predicting. I believe we could see some sideways rotation out. This is a weekly chart. Out through these cycles, possibly through the end of February before we see a push in March back up into this maybe 1450 level. Then we're going to see it slide back down and weaken a bit. This is a reaction. Think of this as the gas pedal of a race car driver. As they're navigating the track, they're trying to navigate turns and other cars, whatever, other obstacles. This is really the gas pedal. Are they accelerating or are they braking? Are they accelerating or are they braking? And what are they doing? Are they navigating a turn? Are they navigating an obstacle? Is there a crisis involved or what? And this is really what we're seeing. So this is clear acceleration, meaning wide open, let's go, move. This is clear acceleration with a little bit of pause, indecision. This is clear acceleration. Now we've got suddenly braking. What does that mean? Does that mean that we have concern? Does that mean that we have crisis? What does that mean? Well, in my opinion, what that means is based on this depreciation value, and come back here to the gold right here, the U.S. valuation trend index. This means that we're hammering out a bottom. Okay, it means that we are struggling to get past this next phase, this next high, trying to get into this area. So we are navigating this new high. We've gotten to new highs. We've gotten to new highs here. We are stalling. We are navigating the next phase upward. And that's what this volatility index is showing us. So what I expect here, ladies and gentlemen, is a bout of weakness, a bout of consolidation, which again, the bears will be telling you, oh my gosh, look out, the market's going to crash, everything's going crazy. And in reality, what's actually happening, ladies and gentlemen, is we're setting up to clear this obstacle to move to the next phase, which is the March-April rally phase, just like I drew right here. So let me, I think I just moved that, which I didn't want to do. So let me come back here. So my server's acting a little slow. Hold tight, guys. There we go. So funny, I do these videos and all of a sudden the server's like, oh, I'm going to slow down. If I reconnect to it, it'll give me more data. But again, here we go. Here's the rally phase. So this is the next March, April rally phase, right? That's it. Just draw it right here. Okay, but where are we at right now? We've come up to new highs. We've cleared the 410 level. That's very solid. Where are we at? We're in this consolidation phase, which will probably last maybe 2-3 weeks, maybe through the end of February. And then we'll start to rally back out of it and move up into this April high area around 436. So back over here, how does this relate over here? This means that we could come back down into this maybe 8.5, 8.0 area with some consolidation. The bears will be telling you that the market's collapsing, that the world's going to end, blah, blah, blah. But in reality, all we're doing is we are consolidating. And this reacts, like I said, these were deeper lows, deeper corrections. Look at these in the upward moves. You see how we saw these moves downward every time the markets pulled back? These were 7 to 10% pullbacks. What happened eventually? The market kept going up 22% throughout this entire time frame. The bottom of COVID all the way up through 2021. Look at 2021 here. We went from 6 to 16. So that's a 10-point move, 140, 150% of this reflation rally. And here we've gone from 6 to 12. If we get some sort of a rally phase out of this, we'll be back up into the 13, 14 area before we peak in April. And that's what I'm looking for, some sort of a real confirmation up in this area. But through this consolidation phase, we're probably going to end up back down here in the 8, 8.5, 9 area, maybe even down here in the 6, 7 area briefly. And that would be essentially a deep low, kind of like we got here. So you see how we got way down here and then came back up and then got way down into this 7, 8, came back up and then rallied. It would not be uncommon for us to put one of these standout lows down here around 8 that looks really dangerous and turn right back around and head back up. So right now what we're getting is consolidation, breaking, congestion, trying to navigate uncertainty before we start to move higher. And that, ladies and gentlemen, is right here. That's this move where we are going to consolidate here, potentially into some sideways activity before we move higher. And that's going to be the next 2 or 3 weeks. So that's really what you're looking at. And again, you can position for this move. This move is going to be 7 to 9% higher if my analysis is correct. You can position for this. This is going to probably happen, in my opinion, somewhere around after February 20th or 25th. Then we're going to start to see some upward trending. It's going to likely last here until March 20th, maybe March 27th, end of March. Then we start getting into some real consolidation ranges here. And I wouldn't be overly aggressive in early April. In early April, you want to try to prepare for this top setup that is going to line up and be aware that we're now looking for a pullback, a broad pullback, maybe 11, 12, maybe 15%. It's going to seem ugly, but it's really just resolving the next wave to the upside. That's all it's trying to do. Okay, guys, I hope you're enjoying. Remember, please go to MENT.com. Please take a look at what I'm doing. If I'm helping you in any way, support my research, support my effort to try to help you. You get all of this for not for free, but for a very low price. It's all set up over here under the MENT.com expert growth member page right here. I'm trying to revise this. I am not graphical. I cannot draw. So I'm trying to revise this, make this look prettier. But for right now, all of the content is here. All of the updates go here, and that's what I'm doing next. I'm going to be creating all of these updates for you to help you stay aware of what's happening. You also have access to videos, my custom indexes, my hot list, my message board, and more. By the way, I am adding intraday modeling systems for traders that want it. It's going to take me maybe another week or so to get those perfected and ready to go, but they are coming. This is going to continue to expand out and give you even more research and more tools to use. All right, guys. Talk to you soon.